Good morning students, welcome back to the class 11 subject business study, and in today's video we are going to go with more two topics, and one topic is deleted by the board itself. So in borrowed fund we will carry forward with the topic considered as public deposits and trade credit. Both topics are easy and simple to understand. In this today's video we will discuss on this also. But before that, we have studied about debentures, and then we have seen the shares and debentures differences, and then with the concept of loans from financial institute and loans from commercial bank. We have studied about this in last video itself. In today's video, we are going to discuss about the deposits or public deposits, how it has been introduced, how it has been taken by the company, how these public issues are being created. We will discuss in this today's lecture. Then we will see about trade credit, and trade credit is a common concept as you have studied in your subject itself earlier in accounts. If not, then you will study in today's lecture itself. So don't worry about that. Let's begin with the first concept as public deposits. Public deposits is also a borrowed fund. Be careful with that. Public deposits is also considered as borrowed fund. Let's go with the concept. Public deposits are the deposits raised by the organization directly from public. Public deposits are those deposits which are being created by the organization and taken from public directly is considered as public deposits. पब्लिक डिपॉजिट है क्या? पब्लिक डिपॉजिट एक ऐसा डिपॉजिट है जो डायरेक्टली हम लोग पब्लिक से गेन करते हैं विदाउट गेटिंग एनी इंटरफेरेंस फ्रॉम अदर सोर्सेस. नाउ इट इज इश्यूड थ्रू एडवर्टाइजिंग पब्लिकली along with financial position. Here this point has says that it is issued in the public by advertisement or by through different sources of advertisement. We issue this public deposits along with the financial status of the organization. Financial statement means the statement which is been there for your organization, whether it is profit or loss, it has to be shown in the financial position itself. Now it carries both middle and small term financial requirement. Public deposits are not for long period of time. It is for middle level or short term requirements. It can fulfill the needs for small scale financing or middle level term financing. It can fulfill the requirements. Now, interest rates are generally higher as compared to bank deposits. In public deposits, the interest rate will be higher as compared to bank rate. Then it is regulated as per RBI guidelines. The public deposits can only be issued after making sure that all rules and regulations or guidelines are being followed by the company, which are being framed by RBI. So these things has to be remembered by you. This is a simple concept and small concept, sweet concept you can say. Here in this 3 to 4 things you have to understand that public deposits are being raised directly from public. Second point is it is being raised by giving an advertisement publicly. Third is it can take care of both middle level term financing or short term financing. Fourth, the general rate of interest is always high as compared to bank deposit. 5. It is being regulated by RBI guidelines. These 5 points can create a one answer for you for 1 mark question. Now, we are going into the merits and demerits of public deposit. Let's begin with the first point, simple procedure. Simple procedure means steps. Here it has been said that bank, it is a simple method of raising finance as it does not involve legal formalities and does not contain restrictive conditions like in case of other loans agreement. Yes, it is. In public deposits you can only publicize or you can give an advertisement and along with the financial position. Here you do not have all legal formalities by writing forms, details, everything. have to give only necessary information along with the deposits. That's it for it. That's for it. It is considered as simple process and low cost. Next point is economical. Next point itself says that it is an economical source of fund as the cost of obtaining deposit from public is generally lower than the cost of borrowings from the banks and financial institutes. Public deposits are having low cost as compared to different sources because here you do not have that much documentation formalities. You do not have to do all the writing work. You have to give only necessary information as a public deposit requires that. Next part is no charge over assets. In public deposits, there is no risk of giving assets to public deposits as a mortgage. Here it has been said that the public deposits are not secured by any assets of the company. The assets can be used as security for long-term raised fundings. It is been clearly said that in middle level and short level financial requirements, we do not require charges on assets. Next point is no loss of control. No loss of control means here public deposit persons do not have to interfere in managerial decisions. That's why the company do not lose their control on decision making. Next part is demerits. In demerits, the first point is this, that unsuitable for new companies. These public deposits are not suitable for the new coming organization because they do not have that much confidence that public knows that organization well. Here public confidence is lacking. That's why they do not be used as a public deposit. Next is unreliable sources. Here unreliable sources means maybe public can spend the money or they cannot. It is unreliable source. Here company reputation is also mattering where the public can invest money as a public deposit or they cannot also. There may be a chance the money can come or doesn't. Here next point is not suitable for long term financing because in public deposits generally the short period of time has been framed. In this it can be said that they can renew that short term into middle term, but it cannot be renewed to long term as because the company is not relying on long term finance. Next point is limited funds. In limited funds, here as the money is taken from the public, the money source is limited, the amount is limited as compared to large deposits. Hope so you have understood this public concept and merits and demerits. We are carrying forwarding the concept to the next topic known as trade credit. But before just give thinking on this, just look into the merits and demerits. If any point doesn't understand, just comment that I'll try to explain it again. Now we are going into the next concept considered as trade credit. The word credit you know, as accounts you have done, you are into the journal entries, then ledgers and trial balance you have completed. Credit means you have taken money, taken the goods and supplies on credit basis. That kind of things are being added here. So let's begin with the concept. Trade credit is a credit extended by one trader to another for purchasing of goods and services. Here only two people can be there, buyer and seller. Seller gives you a benefit of trade credit if you are known person to them. As the buyer will purchase the goods from the seller and they will pay the money later on to that particular seller. Not buyer but seller. Buyer ultimately buys the product, use it, and the amount will be sent to the seller after a specific period of time. Now it has been considered as short-term financing. Here you can give a credit for minimum 15 days or maximum 90 days. Here there is no interest is being charged on trade credit. Be careful with these 3 points. One is it is extended to one trader to another by purchasing goods and services. Second is it is a short-term fund. It requires minimum 15 days and maximum 90 days. It is no charge on there is no charge on interest by paying a trade credit. Next point is merits and demerits. We will see demerits and merits in detail. So let's begin with the first point, convenience source. Why it is convenience source? As it is a continuous source of fund where you can purchase the goods from the seller and you sold out that product in the market, and when the amount comes, that time you can pay it within the 90 days. It is considered as convenience source. Ready availability. Ready availability, it means trade credits are already been available to the credit worthy firms. Credit worthy firms means the organization which are being established, which are having a specific name in the market, they can get the credit facility from the seller. So be careful with this word also. Next point is promoting sales. Trade credit helps in promoting sales. If you give a credit to one person, the another person will also come as a credit basis. The trade credit helps the organization to sell out more products to different people. Next point is help in raising inventory level. If you know that that company will sell more product in the market in future, so what we can do, we can assure that the assets which we are using or stock which we are using for selling purpose, it can be increased more and it can be sell out on the credit basis to the another person. They sell out the product for you and they demand more. So because of that, trade credit helps you in raising inventory. Next part is no charge on assets. Here also you give a trade credit, but you do not take over any charge on assets. If the person is not able to pay, then you can complain in the court, but you cannot take any assets of that particular company. Next part is demerits. In demerits, we have to cover 3 points. One is risk. Risk of over trading. What happens here? If trade credit is more and more, you sell out more and more product to the buyer, then it can be happen that the sales which you want to do, it has been more and more, and once that it is more and more, it is more riskier to recover the amount from that particular buyer. Your buyer do not pay you money, that's why it is considered as risk of over trading. There should be a balance between the money receiving and selling that particular product. Next part is limited funds. Here by trade credit, here the funds are limited, and that limited funds ultimately makes you a harsh position once you do not receive the exact amount from that particular organization. That's example, we can see that your product is for a short period of time and the amount you have to receive within 90 days, but the funds are been limited. So you do not have a source to gain the money except that particular buyer. What happens here? The production gets increased, but funds are lesser. Because you have provided credit to that person. The person is not been in the condition to give you the money, but we have to produce that product in quantities. So as the demand requires. Here what happens, limited funds means you have a limited source of fund from where you have to produce another product. But the funds has to be received later on from the creditors who have taken your product for selling purpose. But the organization is not able to make the product in huge quantity because they are having a limited funds. Next part is costly. Trade credit ultimately after specific period of time gets costlier because the selling price cannot be fixed. As it has been said that in today's market, if you have sold out at 10 rupees per unit, but in near future the same product price gets to 12 rupees per unit, so there may be a problem that trade credit can be a costly. Trade credit is ultimately a costly because you have sold out at 10 and in near future within 1 month the price has gone up. Because of that, a trade credit can be a costly concept. In this today's lecture we have studied about the public deposits and trade credit, and one more topic is been there but it is not available for you this year because CBSE has skipped or it has been deleted by CBSE for further lecture. So because of that we have completed our chapter number 7 also. Notes will be provided sooner as chapter number 6 has been provided already. Chapter number 7 notes will be provided sooner. That's it for today. Thank you.